day, we have just been beaten up. We had one rebound off of this Fibonacci level where we bounced off of it and went up, and we thought maybe hope that we were going to hold the line there and move forward and get positive, so mortgage rates can maybe improve a little bit. When the mortgage-backed securities lose, we lose, rates go up. So this is a bad thing. Well, we bounced out here, and on Friday we had a little bit of a bad day. Well, today we broke that line. We did not hold that line. And this is a very important line because then we have a lot more room negatively to move. Now, you might listen to CNBC, a lot of those channels, kind of what's happening with the 10-year. At 4.330, that was a very, very important level. Now, this is getting somewhat technical, and then I'll go into kind of where we're at right now. We are just above this very critical level where we haven't broken above this since November of 2007. So the 10-year has not been this high since November of 2007. So if you go back on these charts, into the past, let me see if I have this right here. Here is the 10-year note. So you have to go all the way back here to these dates down here, all the way over to November to really get into the above the 4.3 level. That's not a good sign for mortgage rates. It's a great sign if you wanted to invest in treasuries to get a very secure short-term security. That would give you a very, very good return on your money by getting a secured investment at a clip of 4 to 5%. But that's not good for mortgage rates. Here's the 30-year and the kind of the history of where we're at. We go all the way back. This is pre-2008, guys. We need to go back all the way down to, if you really want to see kind of where we're at historically, we have to go back to a distance in the way far in the past to get up to where we were. So we're talking 1986, probably more like in the 1990s. I kind of in that little vein to see where we're at right now. So the fear is real, guys, out there on the there's my hold the line out there in the market. It's definitely a fearful time because people don't know what's going to happen. But as the title of my email said, March Madness, and I'm going to go over that in a bit, but March Madness will be here. I'm going to go over what that is kind of and what my reasoning is behind March in just a second. But I want to kind of go over where mortgage rates are right now and kind of show you how they vary right now. So you're going to hear on the news that they're saying mortgage rates are in like 7.25, 7.375, 7.5. Well, what does that mean? What does that translate to your buyers? Google has actually put together a very, very good mortgage calculator that has built into it all of the loan level pricing adjustments for down payment, credit score, loan type. And I'm actually surprised that it's good. I'm going to walk you through it to show you. So if you look at this is if you just do mortgage rates on your computer, this little calculator comes up. And if you see 30-year fixed right now, 7.394, that's the average rate right now for a 30-year fixed. If you had a $400,000 loan amount, 20% down with a 780 to 799 credit score. Okay. Your buyers may see this and hear this rate and say, wow, rates are 7.399. And then they may get a quote from me and it may be 7.75. And they're saying, well, his rates are high. What they don't say is, well, their credit score is 740. If you go to a 740 credit score, what does that do to your overall rate? Look at that, 7.794 just for the credit score. They went up 3/8. You see that? So mortgage rates are very, 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 well, it depends on a lot of different factors, what that rate is. This is just a very generic way of seeing kind of what the averages are for the area. So if you have somebody getting a conventional loan and they have a 720 credit score, look at that. You're almost at 8%. That's not fun to look at. So when buyers are looking at the ability to buy and the cost, they are getting a little bit of a sticker shock. So that's when we really have to focus on what our options are with the buy downs, the permanent buy downs, the temporary buy downs, and what the refinance rates would look like 6 months to a year from now. You have to show that to them now so that they know, because we have this inventory problem, which you need to listen to Tina Tambor and she'll tell you all the stats on that you can share with your buyers as well. Because of this inventory crisis we have, and because of the lack of homes for individuals, especially the millennial group right now, we are going to continue to see slow appreciation, even in these times where rates are where they're at. Who'd have thought that with rates this high, we would still be seeing appreciation? Everyone thought when rates hit the 7s to 8s back a year ago in October, everyone thought the market was going to crash because of it. It didn't. We all know it didn't. We all said it wasn't going to do it, and it didn't. And the reason why? Because of the inventory. But if you have a conventional loan right here and you're in the 680s, look at it. I mean, it can get ugly. So this is a really great place to illustrate kind of how credit score impacts your actual rate. And same with down payment. If you do 35% down or 40% down, what that does to your interest rate and credit, even loan amounts. If you go down in loan amounts, 200, it's a higher rate for lower loan amounts. So great little calculator. If you guys are ever wondering what rates are, this will give you a really good perspective for your buyers. You could put 5% down. You can do 3% down. Now this doesn't give you the really nitty gritty, and that's where I come in. But this is a really good illustration. But that's where rates are at, guys. So what are we doing? Like, what's this going to be for the future? Where are we going? I want to show you something real quick, and this is not to scare you. This is just the reality of the situation with the financial aspects of our market. If you turn on CNBC, they're going to say that this market is currently on fire, right? Our economy is strong. They're going to say stuff like we're resilient. They're going to say a lot of different things like that. But I broke down some stats that I've been putting together over the last week, and this is a really interesting statistic. I'm going to stop sharing my screen for just a second here. So if you look at the savings, the savings of money in the bank for the United States since COVID, there was an excess savings of $500 billion in the United States from COVID. So when COVID ended, there was $500 billion more dollars in the United States that's spendable for individuals, companies, everything. 500 billion at that time, and that was March. All right, now it's down to 190 billion by June. So if we can look at that timeline, people are spending that money, and it's going to be running out this October. And at that point, this October, that's also when student loan payments start. So we've been living on nitrous for a while because of all of the excess savings and all the excess money due to COVID. And that is slowly dwindling down. That should be back to its normal, or that savings should be back to that 0 point from excess money, October. And that's also when student loans start, but people's spending habits are hard to change. So I think we're going to start to see, and this is where I'm talking about March Madness, we're going to start to see the economy, the numbers start to weaken. We're going to hear more of, okay, this is more recessionary, because a lot of times right now you'll hear the radio, we're not going to have a recession. Well, these things haven't picked up. And I'm going to share my screen with you one more time to show you another graph that I think is really telling. So this is the consumer loans and credit card spending. Since 2020, we were here. We dipped down because there was a lot of cash. And then now we're on our way back upward at the level we've never been at for personal credit cards, revolving loans, and commercial loans. So we're at the highest point we've ever been for those items, for credit card balances, revolving credit card, or revolving loans, installment loans, that kind of thing. So knowing this, knowing that that money's running out, shows me we're going to be in a slower economy in the next 3 to 6 months. Now, why did I name this Monday morning mortgage update the March Madness? Here's why I named that this way. I'm going to stop sharing it right now. We know we have an inventory crisis. We know there's a lot of buyers that are on the fence. I know a lot of you, and I promise you, you all have 1 or 2 people that you know want to buy, but they're on the fence or they're waiting for rates to come down. We've got an inventory crisis. We all know this. We've all heard this. We have rates that are going to come down, and it's not going to happen very quickly. It's going to happen once we see the recessionary numbers really start to kick in, with unemployment numbers going higher and the stock market going a little bit lower. We're already seeing a downtrend in the stock market for this last couple of weeks. So we're going to see it, and we're going to see buyers now start to like peek their eyes up and kind of look towards the housing market again. They're going to hear what's happening. They're going to get excited to enter the market again. And then we're going to be in maybe the sixes and maybe even the fives. And then everyone that was waiting is going to come in at once. And guess what? We don't have the inventory to make that happen. So what's going to happen? We're going to have, and I hope we get the inventory, and I'll talk about that in a second, but we're going to have a very challenging time writing multiple offers on the same home, a lot of different multiple counter offer situations or highest and best. It's going to be that way when rates drop because of our inventory and all the people that are on the sidelines. I tell you, I know there's people on the sidelines because I talk to them every day. Your customers are telling me, we want to get pre-qualified. We're going to probably enter in the spring or this time of the year after the holidays. It's just happening. So there are transactions still happening now, but a lot of people are waiting. And that's why I honestly think it's going to be March Madness. That's always our hot time for buying anyhow in this market. The spring is always a booming time. So just be prepared. So I want all of you to really be focused heavily on listings right now. I have an idea, and I'm working with Angie on it to get some numbers. And I think Angie, she's already sent those over to me. My idea is, as a recession comes forward, the luxuries that we've lived on with all of this money we've had saved up for a while, those are starting to be depleted. So families like mine and families like other ones, we're second guessing taking that VRBO trip to a beach house. We're second guessing going on that VRBO trip to the mountains. We're second guessing that, and maybe we're like holding off. Well, a lot of those owners of those VRBOs and those short-term rentals are doing two things. They're going to be transitioning them into long-term rentals, or they're going to be selling them. So if we can isolate in our farm areas which homes have been marketed as VRBO and short-term rentals, and get in front of those owners now, they're more often thinking right now, I think I'm going to cash in my chips and maybe take all of this equity I built over the last couple of years and do something else with it. I don't know. They may be thinking that, or they may be just converting it into a long-term rental, like a lot of them are. Not a majority, a lot of them are. There's still a lot of really good income producing VRBOs out there. But I want you guys to think of that as another set of homes that you could potentially get as listings. So I'm getting non-owner occupied residences per subdivision. And from there, we can reach out to see if they're long-term rentals or not. We can look in the MLS, see if they've been listed, see how they're listed, etc. So just an idea for you. Now, what's happening this week? Jackson Hole meeting. This is where all of the financial who's over the whole globe are meeting in Jackson Hole to review global inflation, monetary policy, and everything else that's going on fiscally with the United States versus other countries, currencies, the whole nine yards, right? From that, Powell will be speaking on Friday with what they've spoke on from this week. That is going to be a very highly anticipated speech. A lot of people are thinking that's going to be very negative. We are seeing inflation coming down, but on the services side of inflation, it has not come down at all. I won't say at all. It's come down slightly, which is not good, because that means we may see a dip in inflation for the goods part of inflation, but we may see a tick up in overall inflation because that services of inflation isn't doing anything. So the markets right now are expecting a little bit more of an aggressive tone with the Feds as far as tightening even more, which is not good for us short term. But the Feds look in the rearview mirror, meaning they're looking at past data. I'm looking at future, how that's going to impact. They usually make more adjustments than needed, and then the markets really are impacted, and then they cut quickly. Usually 3 to 6 months after they stop, they start cutting. So again, that translates into my March of next year, where I think the rates are really going to start coming down at that point in a significant fashion. Now, there could be something totally out of the ordinary. We still have to think of that the feds are still spending money like they hate it. They don't want it in their pockets. They're spending it. They're selling a lot of treasuries, a lot of bonds in order to pay for the infrastructure bill, the CHIPS bill, and a lot of the new. A lot of the banks were also selling off a lot of these because they needed to raise capital for that banking issue we had, so that kept rates high as well. There's still a lot of spending and a lot of bonds that are going to be hitting the market this next quarter. Once that stops, we're going to kind of have a little hangover for a while, and I think rates are going to get a little bit better. So we may see a little turmoil through the end of this year. So our buyers are going to have to be in that mix, in that unfortunate circumstance with rates being potentially in the eights. But they will come down, and the feds, they'll break things to make their overall monetary policy happen. They will break things. That's what they're known for. Their overall goal is not for people to be happy. It's to make sure monetary policy, inflation is in check, wages are in check, and they will do whatever they can to get there. So they're going to be more aggressive, I believe, in this next couple months, and then we'll see it come back down. So there is good news. We need to prep, as any good farmer or Midwestern person that has a family that's farm knows. When it's not harvest season, you're working really hard to farm. We all know that term, to get ready. And we're all so used to quick turns. It's not going to be that way this next quarter. We're going to have to really get after it, really sow the seeds to be able to get ready for that spring buying season. And there will be business to be had now, but I think it's going to be even better and fantastic come that February, March next year. So let's get ready. Let's plant those seeds. I'm going to open up for any conversations or any questions that you guys have as far as what's happening in the mortgage world right now. There are quite a few really good programs out there for people. We are probably the leading mortgage company when it comes to zero down mortgage products. We can talk a lot about that as well. We have zero down conventional, zero down FHA, obviously VA, USDA. We have zero down jumbo. We do have abilities to get in with very little money. That really helps with first-time home buyers as well. But having said that, I just regurgitated a lot of not scary news, but I think it should at least waken us up to what the next steps are going to be so we can really prepare. We do not want to put our heads in a hole like an ostrich right now. We want to get out and take other people's market share at this point. It's the best time to do that. So do not be in a mode where, wow, it's going to be tough for a while. Let's take a couple of vacations. This is where we really need to do I call it the 90-day burn. This next 30 days, this next 90 days from October, November, December, that's when you want to rebuild everything in your marketing, get ready to go, get out to everybody, reach out to everybody, plant those seeds, and get ready to harvest the buying season for 2024. I know it's a little early to speak of it right now, but we are in an environment where it is a little slower right now. So I thought it'd be a good time to just open up and motivate you guys, because it is tough out there. But there's tools. We can do it. And even if they do wait for 3 to 4 months, that's okay. It's still 3 to 4 months. They're still our customers. Make sure you're staying in touch with them. Make sure you're giving them updates, and just be in front of them and get ready and just capture as many listings as you can. And we'll be good. We'll be fine. It's just every storm ends, right? This eventually we'll look back on it and say, remember when rates spiked? Hopefully that's sooner rather than later. But that's all I've got for today. If you guys want to open up and chat, I'm happy to answer any questions that you guys have. Let's see if there's any. How can they estimate their credit score? Sean, how can they estimate their credit score? Usually most customers have at least some sort of an app on their phone or through their bank that's going to give them a Vantage score or something like that. Usually when you run a mortgage credit score, that is about 20 points lower than what they get from their bank or their app. So if they don't have that, I can do a soft credit pull to let them know what their credit scores are. It will not hurt their credit. It will not even show as an inquiry. And on that note, I don't know if you all know this, but I do a soft credit pull for every single pre-qualification that we have. We have also the ability to run through automated underwriting with a soft credit pull where most people don't. So if they need to know what their credit scores are, let's do the pre-qualification with a soft credit pull. Again, there's no ding on their credit score, and it's not even going to show as an inquiry. We'll get them fully set up. I'll tell them exactly what they need to boost their credit scores with my FICO Boost program that I own. And we'll get them moving forward in a plan without them hitting their credit. So a lot of people like that, but yeah, we can do that for them. So great question, Melissa. Oh, and yes, thank you, Link, for my pickleball awards. yes, I do play pickleball, and we won 2 gold medals, actually 4 gold medals this weekend. So that was a lot of fun. But if anyone's a pickleball player out there, we do really enjoy pickleball on our team. We do classes quite often as well. You're welcome, Derek. Thank you for being on the call. If you guys have any questions on this, jump in the text, unmute yourself, ask away, and I'll be here for the next several minutes to answer any questions that you guys may have. Don't be shy. I'll be here. But if not, enjoy your week, guys. It's going to be an interesting week as far as what mortgage rates do. Let's hope they hold the line and they rebound off that level so we don't get any worse. And really watch that 10-year. Listen for the 10-year, staying below 4.33. That's the magic number. We do not want to close above that. That's bad news. So 4.33. Yes, I'm licensed every state except for New York and Hawaii. We can do loans in every state except for New York and Hawaii. So yes, I can absolutely do Nevada all day long. Thank you, Deborah. All right, guys, enjoy your week. Again, I'm going to stay on here if you have any questions, and we will be in touch. And call me if you need anything. I'm always just a phone call or a text away.